Hello and welcome to another edition of Nucleus Investment Insights. This week I wanted to jump in on the theme about whether some of the key two stock market themes we've been looking at is AI and the weight loss drugs, and stocks in both those are sort of up, hundreds of percents over the last couple of years, and just wanted to sort of look at a couple of new developments in the recent few weeks, and whether we're seeing any overheating in those areas, and what some of the rough numbers are around that. So I popped up a few blog posts recently, so you can grab those from the website if you want. Quick reminder as well, anything you hear today is not personal advice. It's all general, and if you are interested in personal advice, you can give us a call, pop us an email, and we can have a chat. We can have a financial plan, have a chat to you about it. So I'm going to start with the AI side, and we've had this release recently of this new product called Strawberry. Well, sorry, it's in sort of beta release and sort of starting to edge out there, and it's from ChatGPT, and the model is looking to be much better at doing some things than others, and certainly much better at doing some things versus ChatGPT 4. And the question is around this is what does it mean? Where are we sitting in the whole scheme of the development of this? But what's actually been interesting is it's actually got quite a different cost structure in terms of the way it's and compute structure, and so it actually has some potentially major implications for some of the stocks involved in AI. And actually just the whole business model around AI as well. There's some sort of thoughts that I have in terms of that that's sort of worth digging into. So I'll start with I might take a step back before I jump into that though in more detail, and just talk about what problem are we trying to solve in terms of AI. And the problem that we're trying to solve is sort of threefold. There's this data size. We're trying to get more and more data into these models. The parameters that we're using within the models to try and work out are getting bigger and bigger in terms of the number of parameters. And then finally, the compute, which is effectively the combination of those two. And we're trying to minimize the errors. And all the data we've got so far seems that these scale on a log linear basis, so to speak. So I've got these logarithmic charts that I've gotten, and it's probably easier if we start from the right-hand chart. And basically what we're looking at there, for anyone sort of listening into the blog post, is a graph of parameters versus the errors which they think are solvable errors. And it's basically a linear relationship. So the more parameters that get added into these models on a logarithmic scale, and the number of errors on a semi-log scale as well, sort of end up with this straight line. And then you look at the data size that's going into this, and you get that same relationship. And so effectively, what we're seeing is that pretty consistently across models, the more data, the more parameters you add, you just get these better and better results out of it, and it doesn't seem to be flattening off yet. And so that's sort of the issues that we're dealing with. If you look then at, say, that as a on the far left, that's now talking about the amount of computing needed and what happens in terms of that computing, and where there's this theoretical gain, and each of those lines that sort of comes down sort of hits this axis in terms of saying, okay, for the amount of data and the amount of parameters that it's got, it reached you add a certain amount of computing to it to formulate the two, and you get to this sort of test loss amount. And it's so far, this has been a pretty accurate model in terms of tracking it. And so what does that mean? Well, it means that we're still at the stage where you just keep throwing more data and more parameters at these models, and they just keep getting better. And so so we're still in this phase. There's nothing sort of suggesting we're coming close to the end, and we're seeing a flattening of it yet, which basically means each generation is just going to need more and more compute as sort of the first order of it. if you look at these sort of laws, then on a case-by-case basis, so if you look at sort of images and text images and videos and language and all these other things that you can sort of see on chart, and for anyone sort of listening into the podcast, basically we've got those same lines for all those different variables, all those different media sort of separated out, and they end up coming back to that same line in terms of that. The more you add in, the better you get at doing these calculations. Then you cross into saying, okay, well, so we're throwing more and more data at these models, and we need to keep throwing more and more data in order to create better models. Or that's the simplest one at the moment. Is there's potentially at some point we're going to need to get to the stage where you're going to need other factors, but largely at the moment it's just throw more data and more parameters at these things, and that's sort of your number one thing to do. And so to get there, we need more calculation. And that's where it's this trade-off. And I've got another chart sort of showing up. We've got the blue line and some dots, which is the CPU improvements over, from 1990 onwards. And so over that sort of 30-year period, or maybe a 20-year period, we saw this this line upwards, sort of 45-degree line, and then that's faded off over the last sort of 10 years or so, and that's sort of very much flattened out the improvements in terms of computing. But then we've seen GPUs jump through, and that's where NVIDIA, that's its main market, and that's sort of shot up over the sort of last 10 years, and it's back to that. Well, it's actually it's a steeper line on the chart we've got, which does come from NVIDIA, but it's a steeper line than what we saw for the CPUs. So the compute is coming, and doesn't seem to be showing us signs of slowing down either. And so that sort of combines into that. Okay, where are we headed for AI? And at the moment, it's very much around that. We need this more data, more computing power, to take it forward. So what's interesting with this Strawberry is really highlighted by this next chart that I've got up. And what it's showing is that ordinarily, prior to Strawberry, what would happen is you spend most of the compute power was on the sort of pre-training, so building this model. Then you get that sort of, 60-odd% of it or more. Then you get sort of 30 or 40% of it, which is what you call the post-training, which is largely about, I'm asking a question. Oh, can you tell me, what the capital of some country is, and then going, no, that you got it wrong. Send that back again, and so that's the model then, needing to update itself based on feedback and what's happening in terms of people and things like that. And then the final part is this inference. Now, the inference is actually, I've asked a question into my browser, and that's then gone back and come back with an answer. And I think it's quite a, for me anyway, I think thinking about it like a regression very much does give you gives you a feel for the types of calculations involved. So if you're running a regression, you need all this data, you need to do all these calculations in order to come up with some formula that, y is equal to, 3 times x plus 5. And we spend all that time and a lot of data to get to that. And then there's a bit of like, once I've got that and I'm applying it, I'm putting x into the formula and coming up with a y. That's the inference part, which is a very, very simple calculation, but it's a calculation nonetheless. And we're doing that calculation a lot, which is why, there's still, a fair bit of computing, there's still some computing power going into that. And then there's this post-training part about, well, I put the number in, I didn't really get what I was expecting. And so now I can go and say, well, it's actually, rather than 3x, actually, if I use 3.1x, so I end up with a better estimate or whatever it is. There's different variations, and obviously this is a very simplified example I'm talking about. So that's the old model, and that's very similar to software in terms of you spend a lot of money up front, and then once you've spent that money up front on the software, you're now trying to get that out to as many people as you possibly can. The difference in Strawberry is that the inference is still, there's a lot of data, a lot of calculations, a lot of computing power needed to do the inference side. And the estimates are roughly 10 times what you need in the current version. So it's an order of magnitude greater. Now, that's got a whole bunch of different implications, but probably the biggest one is around the biggest one for this is really around the business models of these companies, because and it's this idea that within businesses, if you've got a big upfront spend to create an AI model, and then once you've spent that money, you end up with your AI model. You want to find as many users as possible, and you want to, you're defraying them, and the cost per user is sort of in a way not that associated with this big upfront spend. Like yes, you need to get your money back, but there's not this sort of ongoing. My actual ongoing costs are very, very small. If I can just sell one more to anyone at any price, I'll take that. And so, and what that sort of leads to is a couple of big players, because once you get this stage where, it starts to cost, say, billions of dollars to create your new model, is that there's not that many companies that are willing, if they're not already a big player in that market, they're just not willing to front up and spend that $1 billion to get there. And the semiconductor industry is a great example of this, is that, 30 years ago, or 40 years ago, you didn't have to spend that much on a factory to get a semiconductor factory up and running. Millions or tens of millions of dollars, and you're up and running. And so lots of people can do that. But now you're getting to the stage where you need to spend tens of billions of dollars to build a factory in order to be able to get your costs down to the level that, and the amount of complexity that goes into it, in order to do it. And so the number of players in that market has shrunk dramatically. And I guess that's what I'm coming back to, is if you've got this market where you're the first model, then you end up with not very many people, because there's a few people who can get the big billions of dollars, and then they're the ones who get all the users, and new people just sort of can't get in, can't break their way in. Whereas if the training costs are actually the upfront costs are a lot less and the ongoing costs are a lot higher, it's much more of a service model. And those types of industries tend to have more players in it. And you can find that, existing customers can sort of group together and help fund new startups, or might even start running. If you're looking at today's models, an AWS or an Apple or someone like that might go, well, we're spending this much already ourselves. We actually fund our own model already and pay for a big chunk of it just through cost savings. And so so very different models could eventuate if that's the case. Some of the other factors that if we're heading to this sort of second model is that you could also see, sorry, let me pull up my thoughts on this one, is, the first big one is, is this just a temporary or is this an ongoing issue? In terms of, like, is this just that happens to be that Strawberry is like this, but we're going to have the next set of models is going to be far more like the lots of spend up front and little inference? Or is this a sign where actually this is the way we're headed, is that the inference part is just going to get bigger and bigger and bigger, and then it's going to be more and more like a service model going forward? And so the companies involved might just be looking at cost plus markup in terms of that. The question is on this and with everything is, look, what do people want in terms of how much they're going to spend? So are you happy to have mostly right and free, or do you want it to be almost always right and cost a lot of money? And within different applications, that's going to be a calculation that sort of ends up being say an engineering type thing, where it's like we're helping this to drive a car or design a bridge or do whatever. It's like, we're prepared to spend a lot more money because we want to make sure that the number of errors is minimized. But if it's a social media or write me a song or whatever it is, there's a bunch of other things going into it. There might be, you might end up with more, I guess with less emphasis on trying to get exactly the right answer and more about getting sort of roughly the right answer, and then human input can come in over the top. So so there are questions with that. And again, maybe though that's just a matter of timing in terms of it being that the models today, which are going to cost a lot of money, are actually going to be quite cheap in a year's time or 2 years' time as the compute technology catches up, and maybe this all these costs just keep reducing over time if the computing keeps sort of improving on the scale. The other thing that comes into this is that which chips are going to run this? Now, there's no real signs of CPUs, which is the old technology that sort of runs your computer, and Intel and AMD are the sort of the big players in that market. There's no real sign that they're coming back anytime soon. So they're very much generalists, and the chips that are doing really well are specialist chips within this. GPUs are still the best we've got at pre-training and the post-training side. And so, so that market is still set to grow within those. The real question now is around the inference. Now, GPUs are good at the inference, are very good at the inference. But the question is there something else better out there? And there are a couple of players in this market already, even pre the Strawberry side, who are involved in that inference part and have suggestions. So Grok, GROQ is one. There's a couple of other ones out there, but that are basically have chips that they're sort of targeting very much towards that inference side. And also as well, some of the bigger players, Amazons and Googles and people like that are out, have sort of different versions of chips that they're trying to design within this and use within that market as well. And so, maybe is the question, and it's a qualified maybe, in that potentially some of this inference stuff ends up being a bit more like training as well. And so, there's a lot of uncertainty around this. But I guess what I'm saying is, there's a lot of uncertainty around that. And the other thing is, we're at this really, really early stage of these software. Like, this is not even fully released yet, this software, and we're sort of making these assumptions that could go. We're all trying to extrapolate these trends that could go for, tens of years into the future in terms of where is the value within this. So, very hard to tell, but it's certainly well worth keeping an eye on this space and looking at what the issues are within that. Are there potential issues for NVIDIA? Absolutely. Are there potential business models in terms of the people running this, in terms of Microsoft's and OpenAI and Google and those other ones? Yep, absolutely. There's issues around that. There's issues about the are you going to be 2 or 3 major players? Are you going to be 10 or 15 sort of more minor players? There's so many different things that could be affecting this, and so very fluid. Certainly well worth looking on it at this as well. Oh, and the other one is the mobile technology as well. So Apple's sort of come out and talked about saying, they have a generation of phones coming out that are going to be much more compatible with AI and all these other factors that go into that. I've always struggled with this concept in terms of saying, I'm not quite sure what calculations are going to be on your phone in terms of AI. There's going to need a certain amount of power to do some of this stuff, but it doesn't seem that there's sort of vast differences in terms of what we've got today. It seems more likely that most of the calculations can be done on the server. It's a bit like your search, for example, is that when we're doing a search on my phone, I type something in, it's not doing the calculations on my phone to try and work out what websites are doing. It's sending it to a server, and that server's sort of trying to then say, okay, well, have I been asked this question lots to kind of give the answers back really quickly, or if not, do I need some sort of do some deeper ones and sort of questions about where the request's coming from? But it's not sitting on my phone, and that's my thoughts around. That was already my thoughts around mobile phones and whether we'd actually see more compute on the mobile phone as well. With this sort of Strawberry model, you would suggest that sort of adds another range of difficulty to that, in that the inference, again, is just unlikely to be done on the on your phone. You're probably going to need enough data, and a lot of this is about having these large sets of data, available and in memory, and that can run calculations on it. And it just doesn't seem likely that that's going to sit on your phone. It seems far more likely that's going to sit on a server somewhere. And so, my expectation is that, if you are talking about if this new Strawberry model is the new model, is that there's much less likely to be this need for this upgrade cycle on your phones. I'm sure they'll absolutely pitch it. All your phone manufacturers are going to pitch these as yes, you need to buy the latest and greatest phones to get this, but the reality seems that that if there's limitations, it seems like they'll be limited by the phone makers as opposed to the hardware on the phone. Yeah, I think that's all my major ones there. So yeah, so that's some interesting stuff that's going on in terms of the AI market. But the basis behind that still for me is that, look, should we still be owning this sector? And the answer for me is yes. There's still certainly reasons to be involved in that sector. Does it look like it's wildly overpriced? No, not really. There's certainly not. It's not cheap within that market, but given the growth you're seeing and the potential size of the market and the amount of actual calculations, I mean, we spoke about that. Some of those charts I had earlier, just sort of showing that we're still in this phase where bigger data sets, more parameters means better models. Is that it's a race, and the race is still on, and the race needs more computing power. And so, yeah, the spend is going to be on computing power. Is there an issue around power? Look, yeah, there is a little bit of an issue around power, but I do think there's I'm not particularly worried about that. I think it's probably going to keep power prices higher than expected, but there's definitely this trade-off between how much money people are spending on these chips versus how much the chips cost to run. And the chip manufacturers can see that trade-off. The people doing the calculations are very aware of how much they're spending on a chip, how much it costs to run these chips. And so when chips come out that are more power efficient and can drop the power use, then people are prepared to pay more for those chips. And so the chip manufacturers, they know what they need to do to make a bigger margin. Let's make more power efficient chips. But the flip side is so many people want the chips, and the demand is so strong for these, is that for a certain amount that hasn't been a limiting factor. So it's basically been the customers are saying, give me as many chips and as powerful as you want, and screw the power. I just want the most powerful chips. But as the data centers fill up, or there are constraints around getting the electricity in, then the requests from the customers come back: give me this much power subject to this power. Give me this much computing power subject to this much electrical power constraint, or whatever it is. And so, yeah, I do think there's there'll be elements around that that I'm sort of less concerned about. They're more of a social issue, I guess, than an issue for the companies. And when I say social issues, about the question of power and where it's being used and what it's being used for, and obviously climate change and other issues like that are popping around. So the second part I want to talk about then is the weight loss drugs. And so interesting report out from Morningstar this week on trying to put some numbers around the markets, and I just wanted to, and you'd call it quite a bearish argument from Morningstar on the weight loss drug companies. And so I just wanted to sort of talk around the sort of big picture numbers at what this could be, because really we're all sort of having a bit of a punt at how big this market could be. And again, it's this uncertainty of extrapolating these the trends right now, and how far are we extrapolating them out, how big do they get, and how long does this grow, and how big can the total market size be. So so the report from Morningstar, and actually I should jump quickly just to a quick message before I jump.
We'll be back with the investment insights very shortly. Nucleus Wealth is an active and passive investment manager. If you like what you're hearing and want some help with your investing, we can do it for you via our active portfolios. Our tactical and core portfolios use the insights shared in this podcast to construct and manage your investment. We blend tactical portfolios to offer our combinations of international shares, Australian shares, government bonds, and cash. We vary the asset allocation with the goal of protecting your capital in times of market uncertainty. We also have active international and Australian share portfolios. These are chosen using our quality and value investment philosophy. You can find out more at nucleuswealth.com. Now back to the show.
Right, so I just want to take a step back and just quick remind people of the weight loss drugs. So effectively, we have two companies out there that have got these weight loss drugs, Eli Lilly and Novo Nordisk. One of them's US based, Eli Lilly. It's also got a bunch of other drugs that are actually quite interesting. And then Novo Nordisk is pretty close. It's primarily focused on this. It's got a number of other sort of lines to it, mostly around sort of diabetes and weight loss as well. But largely what we're talking about is these weight loss drugs. Now, we've effectively gone through we're going through three phases in terms of these. Sort of generation one of these drugs have been out for a decade or so. They had relatively severe nausea, gave about 5% weight loss, and helped out a lot with some of these other factors and diabetes in particular. So it brought out as diabetes drugs. The generation two of these drugs, and a lot of them were injectable and I think in a lot of cases daily or on a very frequent basis. Generation two is still injectable, but is back to about once a week now in terms of injections. The weight loss is closer to 15%, so somewhere in that sort of 10 to 15% range is much more likely, and the nausea side effects are a lot less, and that's what's really sort of driven this growth in this market. So we've seen a lot of demand in terms of the diabetes, but demand growing in terms of other factors, and particularly obesity. And one of the real benefits of this drug is that different types of drugs, is that it's primarily focused on making people not feel hungry, and that's the real benefit is if you're not feeling hungry, you don't eat as much, and therefore you don't put on as much weight or you lose weight, and that factor I think is very important in terms of saying that. We need to be worried about side effects, but the side effects, say, if this was something that was making your body run faster and burn more fat or burn more energy or something like that, the dangers there tend to be a lot higher than just, they make you not feel as hungry. So yes, the side effects are certainly seen to be less. Version 3 of the drugs are sort of coming out over the next 3 or 4 years. That most of them are in production and testing already, and they look to be. You've got this whole range of different factors you can get in terms of them. Less nausea is key. Easier to make. So this last set of drugs has been actually quite difficult to make, and so there's been a demand supply imbalance. So the companies haven't been able to make enough to satisfy the demand. So the next step will be likely easier to make. There's some oral ones out there. So basically tablet form or injectable once a month rather than once a week. So there's all these extra benefits you can see. And the weight loss is closer to 20% rather than closer to 15% of this batch. So generation 3 looks again like a relatively big leap ahead of generation 2. In terms of where we could get to, and certainly on the oral drug side, you think that would expand the market considerably in terms of what, the people who are willing to pop a tablet at home versus injecting themselves, and so you end up with these. I've just got this extreme opinions graph up on the chart up on the there, and your two ends of this is that look. The bear case for these drugs is that, look, we're going to see some more severe side effects are going to start showing up. This hasn't been long enough and things are going to pop up. And look, maybe that's, we haven't seen it, really to date, but that might pop up. There might be some sort of backlash against them because there's sort of some data out about how they're changing brain chemistry. And that's part of the reason why they work is they change the brain chemistry so you don't feel as full. And maybe there's a backlash against that. And people just not wanting to mess with brain chemistry. And then the other one is that, look, you won't get mass adoption of this because people just like food, and when you're on this, you just don't feel as hungry. And there's certainly lots of anecdotal cases of people who are on the drug and basically just like, well, I was on it and I was losing weight and it was great and everything, but I'm off it because I just like food, and I just want to be able to eat a pack of chips and enjoy that and live life and whatever it is. And so So that's your sort of bear case. Your bull case is, well, look, doctors are just going to give them to everything from heart disease, sleep apnea, knee replacements, like there's, I don't want to say every condition out there, but there's there's a whole bunch of conditions. The majority of conditions out there are going to help if people lose some weight. So, pick anything. Asthma, is it worse if you're overweight than underweight? Yes. Sleep apnea, the same. Heart disease, blood pressure, whatever it is you want to name. Chances are it's worse for you if you're overweight. And so there's that. Secondly, the manufacturing issues and the side effects are going to reduce as we get later and later generations of them. There's a potential that health insurers and governments will like greatly encourage the use and subsidize the use, with the view that, look, if I can spend $1 today to give somebody one of these tablets, and that means they're going to weigh less in the future, then they're going to have all these fewer health problems in the future. And so actually that's a great investment to spend the money now and get people down to a healthy weight. And then the last one is that, we're just going to be doing it. It'll be like multivitamins for vanity reasons. For anyone who wants to lose a bit of weight and look a bit better to attract a member of the same or opposite sex, we'll be popping them, to save weight. And so, there's plenty of different sort of bullish outcomes you get to on that. So let's get into and again, I don't think my read of the Morningstar report is not that they're complaining about any of those. It's more about some of the specifics about the companies themselves. So what they've got is a bunch of different factors, which I might just pop up onto a full screen so it's a bit easier to read. So basically what they're saying is, the market believes that there's limited competitive risks, but Morningstar and PitchBook think that competitive obesity drugs are about to launch in 2 years' time, and there'll be a bunch of other competitors. They think it's about a $200 billion market, and so that obviously makes a bit of a difference as to whether it's if it's a $200 billion market or if it's a $500 billion market. Is a huge difference in terms of the valuations. They do think that obesity drugs will have a sort of relatively high market penetration, sort of consistent with the market. They think that pricing is going to fall, actually, I'll go through these in a minute, quite substantially. I'm certainly not against them in terms of that. They think that they're right in saying that there is a pretty big overlap between obesity and diabetes and some other drugs, some other markets as well. And what they're saying is effectively that, well, you've got to make sure you're not double counting. So it might be that you've got somebody who's overweight, who has heart disease, and they've got diabetes as well, and whatever, and sleep apnea, or a host of other things. And so that person doesn't turn into 4 customers. There's still only 1 customer. So that's sort of these issues. They think that Eli Lilly and Novo are overvalued. What else have we got in there? That's that's probably the key ones within that. Then they've got these assumptions that they've made, and they've picked 2031. So we're going to use that, as we're looking at these numbers, just to try and get a feel for what's right. So what they're saying is, look, by 2031, you'll get to about a 41% market share of diabetes patients in the US, a 19% internationally, and then you sort of get of what's left, you'll sort of have about a 23% market share in obesity, 13% in overweight, 13% of overweight people, and then internationally that's as low as 1% of overweight people internationally. And then when you look at the costs, they're sort of about they're saying it's basically going from sort of $300 a month ish at the moment for US diabetes back to about 200. Obesity going from about double that to closer to probably 220, 230 a month by 2031. International then prices falling to about $500 a year, so considerably cheaper. And then international obesity sort of coming back to that sort of $200 a month ish level as well. So that's sort of their numbers. They get up to that sort of $217 billion market cap. No, sorry, size of the market, and they think that Novo Nordisk and Eli Lilly end up with about 67% of the market, and that sort of gives you why they think they're overvalued at the moment. So yeah, so look, it's good to sort of see numbers sort of put out there, and I guess this is where the debates start to, if you're making sensible debates about this, is about saying, well, you can be very positive about the outcome of and what's happening in terms of the these drugs and the uptake, but it's a question about how positive, how much should you pay for that? It's not, you shouldn't pay any number, and so I guess some of the key things I want to come back to, I think that's probably worth noting. Actually, let's go back to this prior one. So on the pricing side, I don't have too many problems with what they're saying. I think maybe they're giving too much on the price. It's quite possible the price comes down even further than that, and we've certainly seen that in some other markets. The companies will try and keep prices as high as they can, and then try and be as sort of selective as in terms of how they're pricing it as they can. But and you can see certainly within their assumptions, that they're assuming that US diabetes patients are going to be sort of paying 4 times more than what international is, and that's basically a factor of the US health system and how it sort of allows drug companies to effectively overcharge relative to what other countries. So that's a risk, but it's a risk there for all drug companies, I guess. In terms of market share, look, that's an interesting one that they're sort of saying you'll get back to sort of the two companies between them will be back to only 2/3 of the market. So that's an assumption that we'll get at least 3, probably 4 or 5 other players. Oh, sorry, at least one other player out there, and probably up to 4 or 5 in total that are in this market, which is a relatively a big assumption. I guess we would look at it and saying, given such a head start these two companies have, it seems more likely that they'll be still at the 80% market share range by sort of 5 or 6 years time. Like we're speaking about new drugs sort of coming out 2026, 2027. That's not a lot of time to sort of pick up that extra market share. So I think the market share, pricing, they're probably a little bit over. Market share, I think they're a bit under. The outside diabetes, they've got 60 million people globally. Now that seems low to me, and it really depends upon where these drugs end up. Is that a good example is the hypertension market, and that's sort of 500 or 600 million people globally take some sort of hypertension drugs, and so and that's, I guess, because they're looked upon as being safe and effective, and somebody shows up with hypertension, is like, here, take the drugs. Let's start with that and see how it goes. And the question is whether that's where these end up being. Is it they end up being safe enough and without the side effects, that if you turn up with and the doctor thinks you might need a knee replacement, is that the first thing the doctor says is, well, why don't you lose 10 kilos and see if you still need, see if it still hurts. If you're not carrying that, you get rid of 20% of your body weight, and maybe it won't hurt as much. And so, that's the question: is does it end up like that? Because if it ends up like that, the market size could be much bigger. So let's sort of work backwards, I guess, from sort of back of the envelope, just so you can see the types of numbers you need to do to get to justify the current share prices. So if we look at sort of Novo is about 550 billion in terms of market cap, and this is all US dollar numbers. Eli Lilly about 800 billion, but it's got a lot of other drugs and quite interesting ones that it's got within its sort of universe as well. So I'm just going to guess, just use round numbers. Let's call it 500 billion is the weight loss drug that's sort of already factored into both these companies. So if you went, well, by 2031, it's in this sort of steady state. And whatever profits they make are going to be, you put it on a 25% discount to the market, which is sort of a reflection is it's going to be lower growth by that stage. And also at some point, these things will start rolling off patent, and then you'll lose market share and prices will come down and all that type of stuff like that. So if you sort of set a 25% discount to the market, you're basically going to need about a $31 billion profit from each of them to sort of justify that 500 billion that you're getting in valuation. So it's basically putting it on those numbers. So then you go, well, yes, but 2031 is 6 years away or 7 years away. You need to discount those numbers back. And so like with discounting, that basically means you need, rather than 31 billion, you're going to need almost double that to sort of justify the price. So let's call it 58 billion in profit. And you stick that on, say, a 45% profit margin, and that sort of gives you about 125 billion in sales. So that's where we're at. If I'm then saying, okay, you want about, if each of them is going to have about a 40% market share, you now want the total market size to be about 310 billion. I'm going to carve out some diabetes. So let's just say you've got 45% market share of the diabetes market. And that sort of gives you about 75 billion in market size there. And so now we're going to say, look, can we get back to $235 billion valuation for weight loss drugs and all the other factors, everything outside diabetes. Now, if you said that, actually, I think I've changed my numbers here slightly. Yeah, so just to make the numbers a bit rounder, if you said it's going to be $200 a month, which is sort of at the bottom end of the Morningstar assumptions, and they're sort of saying that you're not quite halving from current prices in the US, and also sorry on the obesity ones you're probably down 70% in terms of cost. Then you're going to need about 100 million people taking this. And at $100 a month, you're going to need about 200 million people to sort of justify current valuations. So now you're saying, well, how likely is that? Well, there's 400 million obese people in developed markets, and there's about another 500 million people who are classified as overweight but not obese. You've got the vanity market, so people who are just going to take this because they might be normal weight, but they just want to be healthier or want to weigh less. You've got that, and that's just developed markets. Then you've got developing markets. Yes, certainly much less propensity to pay, but there's pretty big middle classes in China and within places like Brazil or India, and those people do have a propensity to be overweight. The people who are higher up on the socioeconomic scales in those countries do tend to be more overweight, and so might also be large markets. There might be, at least millions of people, or quite possibly tens of millions of people you can get from that. You got the questions around insurers and governments, whether they start trying to put people onto this. So, I guess I look back at, say, the blood pressure market, and that's a much lower cost in terms of those. But you've got 1.3 billion people with sort of blood pressure issues, and sort of a bit more than half of that are being treated. And so, I guess where I'm getting to is 100 million people just doesn't seem that big in the whole scheme of things. And even if you halve the cost and turn it into 200 million people, like that seems eminently achievable in terms of a market size for this. So so where does that lead us? Well, let me jump to one more sales message, and then we'll talk about valuations and what we should be doing.
We'll be back again shortly. If you like what you're hearing but want a low-cost passive option, Nucleus Wealth is the first to offer passive direct indexing in Australia. The first generation of passive investing was index funds. The next gen was ETFs. Now direct indexing is here with significantly more customization and control. The benefit of direct indexing is you can add or subtract investment themes, and we have almost 100 different options to choose from. For example, you could buy an international share direct index portfolio that excludes fossil fuels and arms manufacturers and has a tilt towards cybersecurity and cloud computing. Alternatively, you could buy a portfolio with no screens and an extra exposure to nuclear power and defense contractors. You can find out more at nucleuswealth.com. Now back to the show.
Right. So both of these, I guess what we've been through is sort of this process where I've just looking at the sectors. What's this latest news, and then talked about what does that mean in terms of the how does it change our view of it, and keeping in mind what I was talking about with some of those at the start as well is that we're sitting at this point where we're very early in the stage, and we're taking data that is very short time periods and trying to extend that out for very long time periods. And so any sort of changes or whatever in these initial starting conditions or trajectories can make a huge difference on where you think these things are going. So, but with that in mind, I think there's, the Strawberry stuff says, well, the AI market, we need to be quite careful about the assumptions we're making about how big it's going to get, who's going to be the winners, and what technologies are going to be used to drive it. So there's some things that at least have us cause for thought around some of the existing players around, and I think it's too early to actually do anything to any of these, but we certainly need to be sort of aware about what's changing. And the very big one that we'll be keeping an eye on is these inference models and how much we start to see some of the other potential, whether we see other AI models moving in the same direction that the inference turns into a big one. And then secondly is, do we end up with some non-NVIDIA players starting to take some reasonable market share in that? And then, we'd have to then rethink our NVIDIA position if that was the case. But, for the moment, given valuations and where it sits, we're still relatively comfortable with that. Around the obesity drugs, I think this is about, and both of them is about talking upside downside, is around that. It's more about saying, look, Morningstar's come out and said, look, here's this sort of relatively bearish take on it. And we look at it and say, well, we can come back to numbers that we think is relatively easy to get to that will justify current valuations. And then you look and say, well, what about these upside cases where it's not 100 million people or it's not 200 million people, it's 500 million or 600 million. And then you can see these massive upsides. There is certainly the downside case as well. And it's I guess it's hard to see a case where, unless you get this some wildly, longer term side effects that start occurring in that mean the drugs just go to zero, is that it's hard to see where the drugs would be taken out of the diabetes market. That still seems to be a relatively set, 50 to 100 million people you're going to get out of that. And that sort of probably justifies half your current share price or at least a third of your current share price. And then the question then, so that's just sort of your downside. Your base case is that, look, it goes, even a sort of a relatively negative base case would end up at the current projections in my view, and then there's this upside that you get from things improving above that. And so so for our part, we're still sort of on board with all those themes, but very much taking each bit of new data and keeping an eye on, because this stuff is all going to make it's all early days. They're all going to be big, but it's all going to make a significant difference on some of the longer term. Each new bit of data has a bigger effect on some of the longer terms than outlooks than certainly what you'd see in more stable companies or more stable industries or more mature ones. So with that, thanks for listening in. Just a reminder, you can get us on all the major minor podcast platforms. We're on a whole bunch of different social medias. You can get us, read the research on our website, nucleuswealth.com. Come here every Thursday at 12:30, and certainly throw in any questions if you get them, and we will try to answer them. With that, thanks for tuning in, and we will see everyone next week.